the ECB were expecting inflation to be higher this year, so are we. Part of it's just a function of base effects. You know, we know oil prices are higher. We know that some other sort of factors are dropping out of the calculation. But look, core inflation is still relatively subdued in Europe, and we expect it to remain so. So look, the ECB set out its stall. It said it's going to do QE, but a little bit less QE. You know, we know that they're pretty much doing that to the end of this year. So I think it would actually take quite a surprise further on the upside inflation or further on growth for them to actually get to tweak that stance. But look, you know, we are expecting a bit of higher inflation, a bit of stronger growth in Europe. That's actually a good thing.
And how will that then affect your view of the spread in the fixed income we're seeing between the European bonds and the US Treasuries at the moment?
Well, again, you know, what the markets have done is they've looked at what the two central banks did. The Fed tightened and raised their dot plot. The ECB extended QE, albeit at a slightly slower pace, and said it was prepared to buy below the depot floor. So two central banks moving in a very, very different direction. And that's what's caused the gap in these bond yields. Can it go much further from here? I'm not sure we really can do. We've actually got a pretty wide spread by historical standards. You've seen that translated into a much weaker euro against the dollar as well. So I think a lot of that again is in the price.